Welcome to Real Estate Insights, your go-to video series that brings together a wealth of expertise from various fields within the real estate industry. I'm Alexandra Puszczynski, associate at Arendt, and today I'll give you an overview of financing real estate projects. Let's start by exploring key factors you need to evaluate when looking for real estate financing. Financing options vary based on the type of property, whether you're dealing with pre-development, construction, or operational properties. It is important for an investor to carry out financial modeling to estimate the projected return on the property based on expenses, property income through rentals, and valuation before and after development and upfits. A borrower should evaluate the costs, including interest rates and fees, of traditional financing compared to alternative sources. The accessibility of financing options largely depends on the type of borrower. Traditional lenders may prefer to provide financing to larger commercial real estate developers instead of smaller developers based on their financial backing. The short-term and the long-term goals for the property will also impact the type of financing a borrower may wish to obtain. Investors may have short-term goals such as annual cash flow targets, or longer-term goals such as portfolio diversification. ESG factors have become increasingly significant factors which should be evaluated during the initial due diligence process. Compliance with regulations like the EU Taxonomy Regulation and the Sustainable Finance Disclosures Regulation and reporting requirements is critical, as ESG can have a consequential impact on both property value and on management. Now, let's explore who can provide the financing you need by identifying the types of lenders. Traditional lenders, such as banks, offer conventional loans with competitive interest rates and flexible terms. Alternative lenders include private equity funds, REITs, mezzanine financing, crowdfunding, and bridge loans. These lenders typically offer creative financing solutions, greater flexibility with loan terms, and financing for higher risk assets. With the types of lenders in mind, let's delve into various common real estate loans available. A construction loan assists a developer in financing development costs. These are typically shorter-term loans with higher interest rates and may require a developer to provide additional security in the form of collateral warranties, third-party assignments, and cost overrun guarantees. Investment or acquisition loans assist with the purchase of an existing property. Since investment properties are likely to generate income at the outset, the repayment of the loan is less risky. These loans typically have favorable interest rates and are offered for a longer term. Additionally, real estate financing loans are distinguished between senior loans and mezzanine loans. Senior loans are the primary and most secure debt. These loans hold repayment priority and they feature simpler terms. Mezzanine loans are short-term financing which are contractually subordinated to the senior loans. These loans usually have higher interest rates and are used to bridge the gap between conservative senior debt and equity financing. Now that we've reviewed the common types of real estate loans, let's explore the current state of the commercial real estate market in Europe. Commercial real estate in the European market has entered a downturn since mid-2022, after a brief post-pandemic recovery. High interest rates have reduced affordability and demand for real estate assets, pushing down prices. Borrowers with variable rate loans face risks due to the rising market rates. Borrowers with fixed rate, shorter-term loans face problems at loan renewal. Developers are experiencing increased real estate costs due to inflation, labor, supply costs, and ESG compliance. Based on the current state of the market, many developers have taken out mezzanine loans to finance unexpected cost overrun for their ongoing developments. As many loan maturity dates approached, borrowers have found themselves negotiating with the lenders to extend the maturity dates, to lower the loan-to-value ratios, or to refinance or restructure the existing debt. That's a wrap for this episode of Real Estate Insights. Thank you again for joining us. For more expert insights from Arendt, follow our Real Estate Insights video series. Stay tuned and see you next episode.